Okay, everyone, welcome to TradeView Live. We're a couple minutes late. We're just coming over from another call, but welcome to episode 10. We're back from our respective time off. Kyle up in Acadia National Park and myself at another national park in Yellowstone. We were enjoying the great American outdoors the past few weeks. But there's a lot to talk about. Again, I'm your host, Ben Tracy. I lead strategic business development at Vizion, joined here by Kyle, our CEO and co-founder. So Kyle, let's go through the disclaimers for anyone new to TradeView Live. What is TradeView in the first place?
Industry-leading trade intelligence. I can read the slides. Yes. So the short story with TradeView is it leverages about 57% of all global ocean bookings made every single day. It's 3 times more visibility to shipments than any other platform in the market. We leverage this booking information to identify 1.5 million company profiles, provide 90-day trade forecasts for every company, every product, every location, map out supplier and product networks, and have baked some AI researcher tools into it for answering your very pressing questions. And if AI is not good enough, you can ask Ben and I right now here in TradeView Live.
And something we've had to answer quite a bit over the last, let's say, 6 months of this trade war is, where does this data come from?
Yeah, good question. So as I mentioned, one of the key data sources is ocean bookings. So that is pulled in from major ocean booking platforms. But tracking data also needs to be applied. So that it comes from the major ocean carriers. We also supplement that with AIS data, rail tracking information, direct terminal connections for events and statuses out of terminals, etc., overland tracking, and standardize, normalize all this data, understand the locations, have built our own data sets around locations, geofences, blah, blah, blah. And what this allows us is unprecedented visibility, both into what is going to be happening with great certainty over the next 90 days, as well as being able to see more around all the shipments happening across the world than any other platform.
And what does this data or TradeView in general allow us to do in terms of seeing ahead of time what's going to be happening in the world of global trade?
Yeah, that's at the heart of bookings. Since we get access to the booking at the time the booking is placed, this can be weeks, if not months, ahead of the actual delivery at its location. And we're actually tracking the shipment from the time a booking is placed, when that booking becomes a bill of lading, potentially multiple bills of lading, depending, and then tracking it through its progression all the way to delivery. So this means that we're looking at operational plans of essentially that's been pulled together by the shipment information, and this allows us to see the future with great detail.
Great. So let's jump into the numbers. A lot has happened over the last 3 weeks, but really since Liberation Day on April 1st, we've been reporting on 3 key regions of shipping trends, of booking trends. Again, that leading indicator, what shipments have been entered in the most recent week. So let's pull that up and review with the audience what's happened since we last met.
All right, here we go. Global bookings, U.S. import bookings, and China to U.S. bookings. So starting off with global bookings, we just added the week of July 7th to this information. Again, we have this data up to the moment, so we can give you this information as of yesterday. Please feel free to reach out if you're looking for more detail and more recent information. But as of July 7th, we're seeing just a pretty tiny change year over year. Global bookings of ocean freight down 2.6% year over year, down 1.3% week over week. Generally speaking, the last few weeks have been relatively steady, only single digit changes up or down.
Yep. And I think when I hosted on my own a couple of weeks ago, we were seeing U.S. import bookings begin to decline back and remain well under what the 2024 numbers look like. It looks like that's continued for U.S. import, and in fact, even more so for U.S. imports from China. That's that last visual on the bottom.
Yeah, very much so. So all imports in the U.S. from any origin still down year over year, 11%, 16% respectively. down a little week over week as well, with a decline this past week of July. Sorry, this most recent reported week of July 7th. And then, as you pointed out, Ben, the China to US bookings year over year change down 30%. That's a pretty meaningful drop.
Yep.
With a year over year change. I think we're seeing the last of the shipments that were placed potentially in May and in June having arrived, and those bookings truly kind of falling off. You can see that going back to June 16th, where you're seeing this double digit 16, 21, 18, 30% drop week over week over week.
And we're now 2 days away from President Trump's threat, especially to countries like Brazil, coming to fruition with much larger tariffs being implemented. Although it sounds like some of these potentially higher tariffs have actually been avoided by deals getting put in place, with most notably in the past couple of days the announcement of the deal with the European Union. So let's, before we dive into that, just give a deeper historical context into these global bookings, U.S. imports and U.S. imports from China, to look at trends over the last 2 years. Are we seeing unprecedented, at least for the last 24 months, unprecedented changes? Which it looks like in this case, global bookings relatively on par with what they were last year, and certainly still above 2023 numbers.
Yep.
Yeah. So when we talk about peak season, typically that's referred to peak season in reference to U.S. imports from Asia, which, if we look at the next slide, we'll see that peak season reflected pretty dramatically in 2024. It did happen briefly in 2025, but we've now dropped well below what that peak season looked like. And in fact, we're still well below 2023 numbers. So U.S. imports overall, we are at historical lows, at least from the perspective of the last 2 years.
Yeah, and again, looking at this pattern as it's played out through this year, so we have this initial drop that's compared to 2024 is very different, which is the fall off that happened in April when the tariffs got announced, and then you have the combination of peak season and trying to get it in before the 90-day hiatus in the tariffs played out. So very interesting pattern this year.
Exactly. And I think that's even more pronounced in this last visual, which is China to US bookings, where you see that dramatic jump up and then this precipitous decline really consistently since about, week 19 of this year, when we saw us begin to drop below 2024 numbers. And now for the last 4 or 5 weeks, we've actually been below 2023 numbers as well. Quite a bit below. When you look at 2023 numbers, they were actually very similar, and in some cases above 2024. That's that green line. We are now well below that as well, close to about 120,000 TEUs booked per week.
Yeah, and we even put out a blog post in the past few weeks, even asking, is there seasonality anymore with these types of shocks and reactions from the market, et cetera. So it's very difficult to understand in terms of what's going to be happening this year. Generally speaking, we're still seeing kind of a drop in demand for Trans-Pacific, as this would be communicating. We've seen an uptick in demand for going into Europe. Partially, you're seeing that play out in the port congestion in North Europe as well. But even the demand for North Europe is starting to wane a little bit, and that's been communicated in rates, et cetera.
Yeah, exactly.
Forecasted U.S. arrivals.
All right. So about a month ago, a little over a month ago, we put out our first forecast, and that's specifically looking at future weeks for U.S. imports, taking the amount of bookings that we see and then modeling that to project the total. And it's within about a 4 or 5% margin of error. So we wanted to go ahead and refresh that forecast, look forward into the next 4 weeks for all arrivals into the U.S., not only predicting that total volume, but comparing it to the year before.
And again, so this first column is what we see as bookings in the system. The second column is our model filling the gap between the booking volume and what we think will be the total. And these two added together is creating our forecast here. In year-over-year comparison, you're seeing, a little bit up year-over-year for July 28th week, even more so for August 4th, a bit for August 11th, and right in line with August 18th. But on the net, about a 5% increase year-over-year.
Which could very easily be flat. Again, within this margin of error, we could be looking at negligible year-over-year increase, if not about flat. Now,
we're
when
not forecasting any major shifts or swings. In short, it seems to be relatively steady. The next,
which I think shows whether it's compensation or being able to reroute goods. Bookings for other countries, not specific U.S. to China, have likely increased, and they're compensating for some of that drop. So let's look at,
and you can certainly see that going into Europe, which might be a topic we bring up in 2 weeks as well, to show that pattern a little bit.
So let's look at one of those ports specifically that are most affected by that drop in China to U.S. bookings, and that would be U.S. LAX. My understanding is this is the U.S. port that receives the most freight coming from China of any other U.S. port. So looking at the next 4 weeks, what is our projected total, and how does that compare to 2024, when again we saw that peak season emerge, at least an early peak season? Actually, we might have been just coming down from peak season at this point in time last year. We might have been already past it. So looking at year-over-year change, it's sort of up and down. We're likely going to see a decrease for this week in comparison to 2024, a bit of a jump for the next 2 weeks, and then likely another drop of over 10% projected for the week of August 18th.
Yeah,
netting out.
Netting out just below 7% year-over-year change, down 7% compared to, up.
That's an increase
compared to 2024.
Yeah. So I think what's interesting here is we're still seeing a lot of those, that initial surge in bookings get translated into arrivals, right? Arrivals are not yet down, at least for the next 4 weeks in comparison to the year before. But potentially closer to September is when we would expect to start to see those actual arrivals translate to a decrease year over year. So yes, as you were saying, let's pivot to Europe. There's been a lot of discussion about what's been agreed. Again, there was this very high, nearly 30% tariff being applied to goods coming in from Europe. No one expected that to really continue or be sustainable. My understanding is that the European Union, according to the Trade Commissioner, was hoping for low single digits in what was agreed with the US, and potentially as high as 10%. That was sort of the highest threshold that the European Union was really going to be comfortable with. So the fact that 15% tariff is now going to be applied to most goods coming in from Europe into the US is actually much higher than the European Union were wanting. We saw the Prime Minister of France make a statement yesterday that this is a submission. This is a giving up. This is a giving in to President Trump and his demands. So EU's not happy, as I guess the point that I'm trying to make. 15% doesn't sound like a huge number when we talk about 50% being applied to Brazilian goods, or the 27.5% that was being applied to the EU for the last couple of months. But 15% is still much higher than the EU wanted. So how does that translate into bookings for the last few weeks? So this summarizes both that 15% being kind of the baseline tariff, as well as 0 for 0, meaning that the US exporters, companies like Boeing, will be able to export to Europe for a 0% tariff, which was not the case before. And in exchange, goods coming from Europe will also not receive any tariff. And so that applies to aircraft parts. There's a hint that certain pharmaceutical drugs will also be a 0 for 0, although all the details around that are not yet confirmed, and natural resources. And so a lot of this would apply to US exports of oil and gas that we're hoping the European Union will be buying more from us rather than from Russia. So let's dive into the automotive industry, because prior to this whole trade war, the US was importing much more in terms of European cars and automotive parts than the European Union was importing from the US. And so this is very much an attempt to try to even out that relationship, if not even reverse it, so that the European Union imports more in terms of vehicles than the US imports from Europe. So
I mean,
what does
just
that look?
look at these year-over-year change roller coaster
Yes,
playing out here,
really
with the
crazy.
surges happening and trying to get things in before the tariffs hit, and then the complete collapse
Yep.
of bookings to make sure you're not getting tariffed.
Yeah, so really interesting to see here. It looks like it's dropping off. We'll see how much it bounces back. Again, this is from Europe to the US. I would like to see this maybe in the opposite direction in terms of US to Europe, and how those exports might be increasing or not. Again, European spending behavior in general has always been lower than American consumer appetite. So as that pertains to vehicles, we'll see if this tariff is really going to impact that type of behavior, or, these bookings in the next few weeks. So jumping over to another region of the world, let's go to South America, to Brazil. We still don't have a deal with Brazil. And in fact, there were pretty strong statements made by Brazil's leader just yesterday, I think it was. And we're down to the final hours, really, before a 50% tariff is applied to goods coming from Brazil to the US, and a retaliatory 50% tariff is also applied to US goods going to Brazil. So from Brazil to US, bookings are down, and they're way down. They were a little bit below 2025 levels, what we met a few weeks ago, and now they are plummeting, I guess is the word.
Pretty divergent at the moment.
Exactly. Now, when we looked at the types of goods that we get from Brazil, we pointed out a lot of different goods. I think a couple of weeks ago, different industries that are impacted. Pig iron, someone who had joined TradeView Live, one of the audience members, talked about the fact that we get 60 or 70% of our pig iron from Brazil every year. But let's talk into something that we get every day. I'm a consumer of this product. Kyle, I know you are. Coffee. I think the number is somewhere in the range of 50% of all US imports of coffee from around the world. 50% of that actually comes from Brazil. So a large amount of our supply is now reliant on it, and potentially going to be subjected to a 50% tariff.
And there's an interesting dynamic here, especially with coffee, right, Ben? Because it's not just that 50% of the demand for Brazilian coffee comes from the US. It's also that 50% props up the price of coffee to a certain extent as well.
Mm-hmm.
So it's an interesting dynamic where if this amount of demand, was changed in some way, shape, or form, it could have a pretty substantial hit on the market rate of coffee, to the point of it being, going down dramatically because demand would have. But I'm not sure how Starbucks would keep people happy if that type of thing happened.
Well, and again, a company like Starbucks is likely able to source from places more than just Brazil. When you look at Costa Rica, Ethiopia, Nicaragua, Guatemala, whatever it might be, and how much of that supply have they been able to store stateside? When we look at green coffee, which is mostly what's being exported from these countries into the US, versus how much green coffee is stored and then roasted domestically, a lot of these roasters are stateside. And so when you talk about that 60, maybe even 90 days of green coffee supplies, which have to be roasted, given to the stores, we're still looking at quite a lag between the tariff being applied and the price of a cup of coffee increasing potentially.
And this might not change so much the price of your, say, high-end cup of coffee, because I don't think that's typically being sourced from Brazil. But like your stock cup of coffee, think like your Dunkin' Donuts coffee or something like that.
Yeah, my Kirkland bulk. I have this huge tin of coffee. It's got to weigh like 20 pounds from Costco, and that's the Kirkland brand. Maybe potentially that's not going to be quite as cheap as it normally is. So this looks at the past 2 years of specifically the HS code for coffee, and just how low we are, not only in comparison to 2024, But 2023, which was a bumper crop of a year, we brought in quite a lot of containers full of coffee from Brazil. We are, of course, well below 2023 numbers. So we want to review and just give an update to the HS codes 72 and I think 73 for iron and steel. Both of these were specifically focused on helping American producers of iron and steel. And we saw a drop in bookings. We saw a slight increase beginning to trickle up the week of July 7th when we gave our last TradeView Live presentation. So what's happened in the last 2 weeks? It looks like we're still well below year-over-year numbers, not quite as dramatically as we were a couple of weeks ago. What does it seem, about 10 to 20% below last year's numbers? We saw an increase 2 weeks ago and then another drop in the most recent week. And again, looking at this year in comparison to 2025, which is that yellow line, 2023, we are still above 2023 numbers, and then right about equal to 2024. And then the same for the second HS code for iron and steel. We could just combine these two next time around, but we are seeing a little bit of a dent into that year-over-year change. Again, a couple of weeks ago, we were almost 45% down from the year before. We were 17% down from the week before. We've started to see that bounce back just a little bit. We're now about 35% down year over year.
Yeah, and just kind of seeing what the typical volume should be expecting for this is about 10,000 TUs. So just comparing, the 72 category, we're only looking at about 1,000 to 2,000 TUs. But the 73 category, it's 10 times as much volume, roughly.
Yeah, many more containers are impacted here.
But this is where the 2025 number greatly differs from the 2024 number.
Exactly. So quite a stark contrast here. And in fact, similar to that view we saw of China to US bookings for the last 2 years, very similar looking line. We are well below not only 2024 numbers, but also 2023, specifically for iron and steel. And looking a little bit more at some of the other metals that are impacted by these higher tariffs, aluminum products, it looks like we are down week over week, but we are not quite as down year over year. So we saw a little bit of a drop since we left off on July 7th. But in terms of year over year, it's been up and down. We're now at this point, we're about 25% down year over year. When we look at that, we're very close to 2023 numbers, but certainly well below 2024.
And that is a wrap in terms of our numbers we reported today. We got a few minutes left. If there's any questions, feel free to drop a comment.
And Kyle, actually, can you refresh the slides, because we actually do have the most recent week. There we go.
There we go.
Yes, it was the wrong image was in here, but for the most recent week, global bookings, U.S. import, China to U.S. But the last couple of minutes, we can catch up the audience to what we were looking at the beginning of the presentation, which I think was just July 7th. We're now seeing the most recent 2 weeks. Don't show a lot of change for global bookings, which is what we expected. For U.S. import bookings, we're seeing a slight increase in the week of July 14th, another drop the week of July 21st. But overall, we're actually above last year for the most recent week of July 21st. But these things sort of even out when you look at a 16% drop, an 11% drop, then a 16% increase. I think we're very equal to where we were last year for U.S. imports overall. And of course, for China to U.S., we are still well below 2024 levels. Even with an increase in the week of July 14th, we saw another decrease in the most recent week. That all evens out to nearly 30% down year over year, China to U.S. bookings. Wonderful.
All right.
Well, I don't see any questions from the audience. Thank you all for joining again, and we'll talk to you in 2 more weeks.
Cheers. Thank you.
See ya.